As an options trader, you probably know that there are two main types of trades that people like to take: credit spreads and debit spreads. So we're going to break these down. So credit spread, that's just a strategy where you sell a higher premium option and you buy a lower premium option with the same expiration date. When you sell the higher one, you receive a credit, a payment for that. So the goal of this strategy is to generate income through the credit received. At the same time, limit your potential loss to differences between the strike prices less the received credit. Credit spreads are considered to be limited risk, limited reward. The potential profit's limited to the credit received. The maximum loss is limited to the difference between the strike prices less the received credit. These are very, very conservative trades to take. However, they are less risky than debit spreads. You do start with a net credit, which means you start in a profitable position. So what is a debit spread? Well, that involves buying a higher premium option and selling a lower premium one in the same security. That results in a debit from your account. So when you buy the higher priced option and you sell the cheaper one, you actually offset the cost of the trade because you do receive a credit, because you pay the premium for the option that you bought, but you receive the premium for the one that you sold. So they're limited risk, limited reward. The potential profit, that's limited to the difference between the strike prices less the premium that you paid. The maximum potential loss is limited to the cost of the trade, what it costs you to put it on. Debit spreads are considered to be a little bit riskier than credit spreads because you do enter the trade with a net debit, which means you already start in a losing position. The main difference is the credit spread, you get money for it. The debit spread, you pay money for it. Does volatility matter? Well, when volatility is low, the price of options are pretty cheap, right? Typically. This is going to allow for your investments to have more profit potential, require less capital when you purchase and put on trades. But you sell the credit spreads, it's a lot more profitable when the volatility is high. The increased price of options allows you to collect more money up front. That enables greater potential profits from that spread. And although it's possible to sell spreads with low levels of volatility as well, you're not going to get the benefit as you would with higher volatility. Generally, traders use a 50% cutoff of implied volatility. Above 50%, credit spreads. Below that, debit spreads. Here's an example of a credit spread. You sell one June call option. Strike price is $30, $4 you receive. You buy the June call option. Strike price of $40 for $2. You pay that premium of $2. So the net that you get is $2, right? Or $200 per contract. And that's the most that you're going to make on this trade. On a debit spread, same thing. Buy one June put option. Strike price of $20 for $5. I'm going to sell one June put option for strike price of $15 for $2. So you pay $3 or $300 per contract, and that's the most that you're going to lose on this trade. This is a really quick overview of credit and debit spreads. We have a lot of information on our YouTube channel about this, and there's different variations for both of them. And using these are going to help you diversify your trading. But the main takeaway is that credit spreads, you get a premium, right? People use that to make money. When you use debit spreads, it just offsets the cost of the trade. And look, I know they might seem complex, but just basically understanding of when and how to use them, it's pretty easy to employ. We actually have an 8-minute options trading cookbook, totally free. It's got some really great strategies in that to help generate income. We actually have one where you can profit 5 different ways in the market. It's pretty cool. It's a free guide. The information to download is below or off to the left here. Just click that link and you can download your own copy.